Across India, millions of local economies run on the backs of small shops, street vendors, and repair stalls. These micro-businesses generate livelihoods, but when pursuing financial growth, they often hit a wall. The barrier is collateral. To secure funding, traditional lenders expect you to pledge hard assets, like land or commercial property, things most micro-entrepreneurs simply don't own. Without that safety net, standard commercial banks automatically reject these applications. This pushes owners toward informal money lenders charging punishing interest rates just to keep the lights on. It leaves viable, profitable businesses locked in place. They have the customer demand and the operational know-how, but they lack the external capital required to buy that next piece of equipment or hire that extra worker. When these local operators are starved of credit because of rigid collateral rules, the entire community's economic engine stalls out. The Pradhan Mantri Mudra Yojana, or PMMY, was launched specifically to bypass this exact roadblock. It offers collateral-free loans to micro and small enterprises. This is possible because of the Credit Guarantee Fund for micro-units. This fund absorbs up to 75% of the lender's risk if a borrower defaults, removing the need for a physical asset to back the loan. But Mudra is a specific financial product, not a universal fix. If you're looking to scale, you must weigh it against a traditional private loan. So how do you choose? The decision comes down to what you are willing to trade. Mudra removes the collateral requirement, but in exchange, it imposes strict borrowing ceilings and slower processing speeds. It provides a safety net for early-stage entrepreneurs, but it forces you to accept distinct limitations on how fast and how large you can scale. We map the Mudra categories against traditional loans based on documentation rigor and capital access. In the bottom left is the Shishu tier, up to 50,000 rupees. It's a low-friction entry point for first-time entrepreneurs with zero credit history and minimal paperwork. But scaling up requires moving to the Kishore and Tarun tiers, which offer up to 10 lakh rupees. You need this level of funding if you are buying industrial machinery or opening new physical branches. Here is the trade-off. Applying for Tarun requires formal financial statements, Udyam MSME registration, and detailed business plans. At these higher tiers, Mudra demands the same level of bureaucratic proof as private banks. The only difference is they aren't asking you to hand over a property deed. The easy paperwork marketing of the Mudra scheme strictly applies to the lowest tiers. Serious capital requires serious compliance, regardless of the scheme. Mudra also enforces an absolute hard ceiling. Borrowers are strictly capped at 20 lakh rupees. Traditional business loans, by contrast, base their limits on your business valuation and cash flow, meaning they are practically uncapped. Even within Mudra, you cannot simply walk in and ask for that maximum 20 lakh amount under the newest tier, Tarun Plus. There is a strict graduation requirement. Accessing Tarun Plus explicitly requires a proven track record of taking and successfully repaying a previous Tarun loan. The Mudra architecture intentionally acts as a speed limit on your growth. It enforces a proving ground to protect the lenders before releasing maximum capital. Then there is the reality of who actually disperses these funds. Mudra relies heavily on public sector banks and their traditional underwriting protocols. Because of the sheer volume of applications and rigid banking rules, securing a Mudra loan can often take weeks of processing and multiple branch visits. Traditional private NBFC business loans operate on a completely different timeline. They analyze digital data footprints and can disperse funds in 24 to 48 hours. The catch is the price tag. To get that speed and to bypass the 20 lakh cap, borrowers must accept aggressively higher interest rates and possess a strict, pristine civil score. As a borrower, you are paying for your business expansion one way or another, either with your time waiting in the Mudra queue or with cash covering higher interest margins in the private market. To route your business to the correct financial instrument, start here. Do you have hard collateral to pledge? If the answer is no, and you are a first-time entrepreneur with zero history, you should default immediately to the Mudra Shishu tier. If you have an established business but need more than 20 lakh rupees, or if you require funds in under 48 hours to secure an immediate contract, you must seek traditional loans. If you need an equipment upgrade under 10 lakh rupees, lack collateral, and can afford to wait through the longer approval times, target Mudra Tarun. Keep in mind one critical exclusion. Businesses seeking loans for direct crop farming or land development are explicitly excluded from PMMY. You must seek separate agricultural lending schemes. Applying for the wrong tier or the wrong loan type entirely is the primary reason banks reject applications. Routing yourself correctly from the start saves weeks of wasted effort. Mudra provides a starting point for getting a business off the ground without risking personal assets, but it isn't a permanent substitute for building a formal credit profile. The ultimate goal of leveraging these schemes is transitioning your microbusiness into a formal entity, capable of commanding its own terms in the private capital market. Credit is a strategic tool, not a prize. Long-term growth depends on matching the financial system to the actual maturity of the business.